Welcome back. I have again the pleasure to have Martin Tixier here, one of the greatest global macro strategist and an expert also on private credit. Hi, Martin. Welcome back to our show. And we discuss what has been happening to financial market in the world, general in geopolitics. So did anything happen since we did our last call?
Well, yes, I think we've seen some very big exogenous factors coming into play, hence the latest title of my post, which is called Blowback, because they've just opened the Pandora's box when it comes to the Gulf. With the attack on Iran from both Israel and United States, the implications for the whole region as a whole are spiraling a little bit out of control, and the implications when it comes to supply chain management are going to be very large, very significant. We are already seeing secondary pressure coming on the market, for example, for jet fuel. If we're simply discussing jet fuel, you're already seeing a doubling of the prices of jet fuel in the Asian region. Singapore being a very big hub when it comes to jet fuels. And if we take Australia, they have 16 days of reserves for jet fuel and around 14 days for diesel. So the issue is not only the oil prices where everyone is focusing on, but the issue, of course, is regarding the refined products and all the implications for the region, such as helium products, which serves as a building block for chips, as well for the medical systems. You also have the implication of urea and fertilizers, the region providing around 30 to 35% of the quantity of fertilizers needed for the crops. And on top of that, you can add as well the factor of aluminum, given that one of the largest smelter in the world in Qatar just closed down, and they represent around 30 to 35%. We're really looking at a supply shock.
Yeah, no, absolutely. And let me jump in here. And as we record this, the biggest gas field in Middle East is burning as well. But let me come first on the global implication of it. And I have been also writing in my last Global Real Estate Monthly about the three scenarios, what could happen from here because of the big macro implication it has, not just on this region, but it also has generally. So the scenario one is more like a short-term conflict that should have already ended in this scenario already, or needs to end actually over the next hours or week, actually this week. Then a bit the longer scenario, which lasts like disruption up to like 2 to 3 months, and really then a scenario seen like in the Gulf War of what was it, 79, which caused the second oil price shock and inflationary shock in the higher inflationary times in the 70s. So where are you in this? Certainly, I also been nobody knows. I also assigning probabilities to those scenarios. But what is your opinion on this?
I think the damage has already been done for a very simple reason, because you cannot switch back on the natural gas production of Qatar just by pushing on a button. This thing will take time to restart, at least 2 to 3 months. So it means like for the next 2 to 3 months minimum, you will have 20% of liquid natural gas off the market. That's a fact. You also have the implication of refining industries being shut down, smelters as well. All these very highly industrial, complex process take times to restart. You just don't push a button to restart the activity. So, as you said, the shorter it goes on, the lesser the damage. That's what I think is the macro scenario. And as you mentioned, the fact that now the gas reserves of Iran has been struck, we are in uncharted territories, because if Iran starts retaliating in earnest in the local area, then the damages can be much more significant and for a longer period of time. This is a very big concern. Is that the escalation later is still being climbed on, by the belligerents, and it doesn't seem to be any willingness right now to de-escalate on both sides. So it's very difficult to assess the damages, but the damages are already very, very big. If we take out, for example, the containers market and as well the shipping companies such as Maersk, the big ones, CMA, CGM, you have a
Mhm.
double implication. First, the cost of the containers, the traffic being rerouted, but also the secondary impact is already you have like a very significant rise in bunker fuel. Now, if you take into account that around 40 to 45% of the price of a container comes from the fuel price, from bunker fuel, which is a refined product, then you have a big issue. And it's very difficult to quantify the damages from a supply shock, as you said. Uh, if you compare it to 79, there's a very big difference. Is that 79 was a supply shock, which was linked to an embargo, which means that the industries were a little bit shut down. But it's, I think, much more dangerous because some of the infrastructures is being destroyed, which is different ball game. The implications are already significant. We can see, and I'm expecting, for example, credit-wise, to see a significant widening in CDS spreads for airlines. You already see a reduction of traffic, like the airline company SAS has already announced they're going to suppress around 1,000 flights in April 2026. So there's already some spillovers that are starting to show up. So as we said in the conversation, the more it goes on, the bigger the damages.
No, absolutely. That's quite concerning also on my side, on the real estate side. And, I'm also writing a newsletter on the real estate side. So there are also some beneficiaries of that. Hospitality is quite an interesting animal. On the one hand, travel is disrupted, the fuel prices leading to higher ticket prices. But I was also on a call with a Spanish hospitality manager, and they have seen that the bookings already increased, and we have a new tiering in the European hospitality market. One speaks now about Eastern Mediterranean and Western Mediterranean, so it's quite interesting how quickly such new segmentation is coming up. So, and how quickly people
Absolutely,
react to
and from
that.
my perspective, yeah, yeah, and absolutely, and from my macro perspective, I think the biggest beneficiaries, at least short term, for this year for sure, in the hospitality sector, and even from a macro perspective, is going to be Southern Europe, the Club Med countries, as we call them. If you take into account Portugal, as we mentioned in previous conversation, they are borrowing on a 10-year basis at lower levels than France, just because the long end is controlled by fiscal discipline, as we mentioned before, and they have had 4 years of budget excess. And on top of that, if indeed the traffic, the hospitality could favor locations such as Spain, Italy, Greece, Portugal, the surroundings of the Mediterranean Sea, then obviously Southern Europe is going to benefit from that, which puts them in a much better position. For example, a country like the Emirates. If you think about it, Dubai, the Dubai traffic in 2025 serves around 260 countries, 6 continents, and as well around 95 million passengers. And that hub is currently being shut down. So we are seeing a lot of disruptions, which could favor, in effect, as you mentioned, hospitality sector for
Yeah, no, absolutely. And one thing is, we also updated our note on the Dubai real estate market just this week. And we issued a longer paper last year where I was a bit concerned about the supply that is coming on Dubai. Actually, over the next 2 years, the supply should have tripled each year. And I was a bit concerned that something could happen on the demand side, because the real estate hawk cycle usually works that way. Usually, if you're building too much, just at that moment you get a Murphy striking. But I would never have expected that we have such a tragic event for the Dubai market. And I really I still hope for them that they can recover, but it looks currently it is really, we need to be realistic, unfortunately here.
Absolutely, and you have to that the supply shock which is being unleashed right now, which we don't know how large is going to be, could as well impact very significantly construction costs, which
But
have already risen quite significantly in recent years. On top of rising in funding costs, because we're already seeing pressure on sovereign yields and financing being restrained because of the inflationary nature of the supply shock and secondary inflationary wave, which is starting to form.
No, absolutely. I also have been highlighting the swap rates, which are quite important for the European fixed mortgage market. And this one has again rising. We're again reaching almost all not all-time highs, but the highs which we haven't seen since a couple of years. So almost the highs after the Ukraine war, despite the rate cuts actually on the short end. There are some risks, and there are also other risks I want to discuss with you. You are really an experienced credit guy, have been there during the GFC. And what we have also seen, and people now
Yes.
losing really the focus, is private debt and on private credit. So we have seen that BlackRock needed to mark down one loan from 100 to 0. And we keep hearing
Yes.
now more and more news on that. And how you see it, and what are the implications for high yield?
I think I've already highlighted last year that I was seeing I was looking at triple C's, because for me, triple C's in the US high yield being the weakest rating is the weakest segment. And for me, is the credit canary. And when the credit canary starts singing, then obviously there is a cause for concern. And what I saw for over a year is the gradual weakening of the performance of triple C's, which is significantly high beta, and has been significantly outperforming the double Bs and the single Bs for the last couple of years, having a similar kind of, I would say, performance as an equity market because of the nature of the high yield in triple Cs. But we mentioned in previous conversation that one of the factors showing that the credit cycle was turning was the rise in dispersions in both the equity market as well as in credit market. And what we're seeing year to date is that the total return for the high yield sector, at least in the United States, is negative. Not only for triple Cs, but as well for double Bs, single Bs. And for me, it really means that on top of the exogenous factor we're seeing coming from the Gulf, you have as well some kind of contagion coming from private credit. And the issue with private credit relative to what we experienced during the global financial crisis is that we had, for example, the CDS market as an early warning system. Because when you have public markets, listed bonds, then obviously credit spreads are indicative of growing risk. When you see spreads widening in the CDS space, then obviously you know that something is going on, and you see rising dispersion on the issuer level, so you have some signals. But the issue with private credit is coming from the lack of liquidity and the way the loans are marked. And what is significant, I think, is like very large, sophisticated credit players, such as the likes of KKR, Blackstone, BlackRock, Apollo. All these guys have experienced some kind of losses in some of the lending they've operated in some spaces due to some Ponzi unfolding, where you had some collateral which were pledged several times. And now there's a cause for concern. You're already seeing some significant redemptions because of the contagion effect. And it doesn't mean that everything is rotten in private credit. Absolutely not. But the issue is once you start having question in one sector, things can unfold quite rapidly because of the fear factor, because of reflexivity, as George Soros would call it, and the contagion effect. So what we're seeing right now is effectively, I think the credit cycle is really turning because you have rising dispersions, significant weakness for triple Cs in US high yield, And on top of that, now you have this supply shock coming from what's happening in the Gulf right now. So you have a conjunction of factors which is really kind of reminiscent about what you and I experienced during 2007.
No, absolutely. I think that's a great conclusion, and people should then continue to monitor the situation. And I think we will also come back here. If you don't have anything else to add, Martin, I think there are a lot of topics, but I think we come back. So.
Absolutely. I just want to add as well, which is concerning, is wars are inflationary in nature, and as we mentioned before, you're not getting any protection in the U.S. long end, for example, because of rising volatility in the bond volatility index move. So, I mean, if you want to play defensive, you need to keep a low duration. And I think the best cushion you can get credit wise, if you need to have fixed income exposure in the credit sector, is first to be very selective in a sector, such as the energy sector, provide you some protection as well in investment grade, but as well you need to keep duration pretty low. I think in the bucket of 1 to 3 years, even 4 years, because you don't have any protection in the long end. We've seen a significant volatility since the beginning of the month, where like you had U.S. 10-year receding to 3.95%, and now the U.S. 10-year is trading around like 4.20%. So volatility is very big in the long end. So you're not offered any kind of safe haven as you could previously see in U.S. markets.
Absolutely. That's a good final comment, a good take-home message to shorten the duration in the portfolio and go more for rather short duration. Thank you very much, Martin, and
Absolutely.
we
And
come back
switching, I would
again.
say, I would, yeah, I just wanted to add one little thing. I think it's time to play a little bit more defense, like rotating from high beta to investment grade, and keeping a duration pretty low. That would be the message which are coming from credit markets, I think.